Hey, what's going on, everybody? Back at it. Another Ask Me Anything happy hour following up from just an epic wealth webinar. Hopefully all of you were on the wealth webinar. If you weren't, make sure you check that recording out on YouTube. But on this Ask Me Anything happy hour, we're going to deliver. We're going to answer your questions. We've already got questions coming in, so get yours ready because we're about to go around the Brady Bunch here, and then we're going to dive into the most important thing, and that is, what problem are we solving for you today? It's happy hour time. We'll see you in a sec. All right, that wasn't even quite a minute. So we're back at it. Ask Me Anything happy hour where we answer your questions as a group. So let's go around the block here for the Brady Bunch, starting with that way, Mr. Fouts.
Hey, everybody, Brian Fouts here up in the Great Pacific Northwest, which, Jason, I know you love it up here. It's all nice and cold and rainy. Actually, I'm in Alaska this week. I'm picking up my kids from my parents' cabin up in Alaska, so we're actually headed back tomorrow, but had a nice break from the sun down in northern Idaho, but be back in Idaho. But, yeah, I've been having some great calls this week and solving problems. Keep that going. So over to Shauna.
Hi guys, it's Shauna up here in Western New York. It's officially summer vacation for Harper. She had her last day of 7th grade today, and now I'm tasking her with putting her bags of stuff away, like all the stuff from her locker, and she's nice and happy about me giving her that duty to do. So I'll pass it down to Steven.
Hey, what's up, guys? Hats off to everybody for being here. Appreciate you guys showing up each and every single week. It's been a fun day today. What the F this morning? Just so much going on in the country and the world. It was fun kind of talking about some of that stuff, especially with what's going on in New York City. But nonetheless, Wealth Webinar was incredible, talking all about all the success that our clients and members are having through Private Money Club and using their policies and self-directing. Just a lot of really cool stuff right now. And with the way the economy's going, people are really tightening right now, really restricting. And so empowering yourself to have the education, the confidence to continue to grow your wealth, be smart with it, just means the world. So what we do right now is more than important than any time since we started doing this over the last 5 years or so. And so it's just super excited to answer all your questions and provide as much value as we can today. So appreciate everyone being here. Over to you, Mr. Craig Yenny.
Good afternoon, Craig Yenny here. And I was the silent one on a wealth webinar today. All queued up to do some stuff. We're going to do that next week. But anyway, it was kind of a fun webinar to listen to Noah and Kevin Shortell and just kind of the foundations of some of the things we can do to build wealth. Anyway, I'm in the Rocky Mountains of Colorado on the Front Range, waiting for some storms to roll in. So Shane, I don't know if you're preparing for that too, but I keep getting promised by the weather people that we're going to get all this rain and we get a drop. So anyone that's got rain, send it up to us. We're looking forward to it. So that's all I have to say for now. We'll go on to Carson.
What's up, everybody? Over here in Southern California, Dana Point in Southern Orange County, if you guys are familiar. Not been on the AMA in a couple weeks, so excited to be back here at the favorite, best Brady Bunch on YouTube. We got everybody here today, so we're excited to answer you guys' questions. Thank you guys for being here. And we'll wrap up the Brady Bunch intros with Mr. Jason Sipple down below.
Thank you, Mr. Carson. It's awesome to be here with all of you. You don't have to be here, but you chose to be here to ask us questions. So we got to give yourself a high five. And as Snaggy said, it's definitely the times where we want control and we want guarantees. So what better way to get those than ask the questions that you're maybe afraid to ask on a one-to-one call? Ask in the chat. Pop them in there and see what happens. You'll help somebody because I'm sure that you're not the only one thinking that. And by the way, I'm in the City Beautiful, which Steven loves. And here, look, perfect timing. There's Ethan Evans. Welcome to the show, Ethan.
Hello, everybody. Ethan Evans here from the mid-Michigan area. I've been out for the last couple weeks as well. I was doing some training with the National Guard, doing some getting ready to look at some strategic level stuff. So glad to be talking back about strategy for you guys and how to put your policies to work and keep your money moving. So that's all from me right now. Glad to be here.
Ethan, you looking at some strategic bunker busting these days?
No, not quite. It's the baby steps at strategic level. So I can't speak on any of that.
All right, let's dive in, Shauna. What are the questions?
All right, well, let's start with this first one. So Kathleen's saying, Carson, do we have a baby yet? We'll start there first.
There you go. We do not. We are about 6 weeks out still. Thank you for remembering and asking. I appreciate it. This makes you guys want to come back every week now, get updates from me, right? So we'll keep seeing you every week for the next 6 to 8 weeks, and I'll give you an update, but we're not there yet.
All right, love it. Okay, so Shane is saying, hello from Aurora, Colorado. Curious which companies you use for policy-backed lines of credit and what the current APR range is with them. Thank you.
Is anyone else using CV lines of credit, or is it just me?
I think it's you and Devin Bird. That's
All right.
I've
So
all heard.
I found, so the company I used to use, which name I'm going to leave out, like very unhappy with them. But the new company I'm with is called Busey Bank, BUSEY Bank.com. I think that's what it is, Busey Bank or something to that extent. They've been phenomenal. Literally, the rate's a bit higher than what you're getting with the insurance companies. They're at 6.7. If Jerome Powell ever gets off the pot and starts dropping these rates a little bit before we lose everything in the economy, then that'd be great too, because it's going to follow rates down. But the best part about it is their service has been good. I've got access to 95% of my cash value, which is about 5% more than what you're going to get with the insurance companies at about 90. So you get a little leverage there. Super easy to use because I have lots of policies pulling into it. I think I have like 13 policies. There might be one policy that's not attached to it, but all the rest are. So I've been nothing but thrilled with Busey Bank.
Like Gary Busey, did he start this bank?
Yes, it's spelled the same. I Googled it just now.
Maybe it is. Who knows?
No, that'd be a cool bank. I mean, there's some good movies that man's put out. So
That's so funny. I literally Googled Gary Busey's name when you said that.
I did as well. That's why I'm literally looking at his movies, Point Break, the Buddy Holly story, Under Siege, probably looking at the same page you are.
Yeah. All right. So something Sandra says sometimes, freaking awesome name, is saying, wanting to know if IBC can work for a 60-year-old solo female with only a mortgage debt. I have some hard cash reserves and a money market account and want to maximize my leverage.
That's a lot of alliterations you got there, Sandra. And yes, 100%, it could definitely work to not only control your money in maybe a more efficient way, but also give you more guarantees and, build up that opportunity fund over time. And we could talk to you about why the banks own $225 billion worth of bank-owned life insurance, which is just what we're talking about here, just at an individual level. So,
and this might be someone I might be talking with right now, one of my clients as well. Great question. And I think I may have mentioned her to ask it on this thing here. But yeah, I mean, what are the there's multiple options this person has. And so you've got to look at all the options and put them all on the table. And we can help you look at what is the best fit for what you're trying to accomplish, because what you're trying to accomplish is what we got to focus on first here too. What's the goal? What's the outcome we want to accomplish? With infinite banking, is it, debt payoff? Is it having reserves for down the road? Is it retirement, supplemental retirement income, or all the above, to be honest. But yeah, there's lots of ways we can make this work.
Yeah, Lucy, thanks for sharing. Speaking up, she said, as a 63-year-old solo female, I can say, yes, IBC works. Love that, Lucy.
Yeah.
Someone's calling in with questions. And we have a caller on the line. How are you today? Dave Ramsey, good to hear from you today. Good to hear. Thanks for calling in. What would you like to know? Yes, IBC does work. Yeah, absolutely. We even put that term you love on these whole life policies. Hey, Dave Ramsey, thanks for calling in. We'll see you later.
Yeah, Dave, we could probably help you get started with your fifth policy, just get underway.
Oh, and actually something funny about that, you mentioned Dave Ramsey. So the client I talked to yesterday, who is 60 or 61 and has a mortgage and all that stuff, they're in a very kind of a financial bind because they haven't saved for the future. But guess who they follow for the first 59 years of their life?
Dave Ramsey.
Oh, yeah, absolutely. And they're like
Can't
saying,
save your way to wealth, man. Can't do it.
Yep. And they had one thing to say. They said, I wish I had not done that. There you go.
All right. Justin Streeper is saying say you want to pay a loan for a car and it's at 7% at the dealer, you can take money out of your policy at 5%. Did you pay back yourself at 7%, or would that MEC? Or basically you'll pay it all sooner at 7%.
Let me hit on this one. Yeah. So Justin, I mean, because I've done this a lot, everybody can do this differently. So I'm just going to give you how I do it, because it's the simplest way. And it's exactly what you said. You went to a car dealer. They said they could get you a loan at 7%. And you probably already have like the amortization schedule or the loan payment. I pay myself back the exact amount the dealership or the finance company would charge. I've evolved like the last few cars. What I've done is I've gone to bankrate.com and searched for the best rates in the industry. Ally Bank has been like, for the longest time, the lowest rate. But let's say it was Ally Bank and they were at 7%. I would pay myself back 7%. Now, here's the beauty. You have no worry about mecking, because if you're paying yourself back at 7% for a car loan, all you're going to do is you're going to pay that loan off sooner. So if it's a 5-year term and you're paying it back at 7%, but your loan with the insurance company is at 5%, you're making a 2% spread. So that 2% is going to go to pay your loan down faster. So instead of your loan taking 5 years to get all the money back for your car, it might only take you 4.5 years. And me and Craig got some crazy shit to show all of you. I just can't wait. I don't want to hold it in any longer, Craig, but I know I have to. Do you know that if you took a loan on your policy at 5%, Justin, and you paid yourself back at 5%, do you know you'd still make money? That doesn't make any sense to anyone, does it? If you had told me that 5 years ago, I'd be like, no, dude, that's stupid. Like, you're breaking even. Like, it's the same. It's not the same. And we've got proof mathematically it would be. So, Justin, if the dealership's going to charge you 7%, pay yourself back 7%, because treat your money the same way you treat the bank's money.
And Chris, you know what? I saw that message from Justin. I thought, well, let me plug this into this thing that we're building. And, I just made a quick assumption. If you borrowed $10,000 at 5%, you paid it back at 7% on a 60-month schedule. You would pay that loan back and have $2,265.75 extra. So, Justin, what would you do with that? If you could put it in your PUAs, you could put it in your PUAs.
Yeah.
If you can't, you might want to use that for premium next year. And here's the beautiful thing about it. Let's say that you continually have this problem where you have all this money sitting around. Well, that's when you think about, is it time to start more policies? But hang on. The software's coming. You guys are going to see some cool stuff, and
beyond cool stuff, like just
in a very short time. I'll just put it that way.
It's gonna totally change the entire industry.
I love it. I want to give a little shout out here. So Chosen 1970 is saying, "Hey guys, I finally got my policy issued today. What ideas do you have for passive income with only 40,000 dump in and 20,000 in initial debt?" And then just Shane kind of said, "I love getting on PMC to find passive income deals."
It's kind of funny. Like just the other day, Steven and I were doing a training, and PMC, privatemoneyclub.com, when you're a premier member on there, you can set notifications to send you only the deals that you're looking for. So, Chosen 1970, you could go into PMC, create your account. This is only premier members. And you could literally tell it you want only deals with, what would that be? $20,000, for only 20 grand. But this one popped up because it sends me new deals every day. But this one popped up and it was a really good deal. Set it up and make money. Slow flip, $30,000. So 10 more than what you may have. But I'm just using this as an example. 12% interest, 60 months, first lien position. This borrower on here, it's a family, certified premier member, like just freaking everything in here I could ever want. So it was by pure chance I pulled this up. But just so you know, you're looking for a place to move your money or make some extra, Private Money Club's the spot, man. Like, it's just getting better and better, and the quality of the borrowers are just awesome. You got to do your due diligence, but that is a good deal.
That sounds like the deal that was shared on Money Club Monday too. That gentleman it was like 40 grand, I think, for 50 months. 50 months.
Yeah, there's tons of them. I mean, that was just one that popped up in my notifications.
And congrats, Chosen. One thing too, I love the advice and kind of the guidance Chris just provided, and Shauna. And also that $20,000 in debt, I mean, that's already a chance to make that small money movement and bring that back to your family. Like whatever the debt was you're paying off, you're already seeing it work. You're building it back up, and then maybe you have that extra 10 grand within a few months to put back into that investment that they're talking about.
And then Christian O'Mara saying, okay, so my question, and I know Carson answered it, but I'm still confused. So if you don't have the full amount to make a deposit and it's about to expire, how does the process work if you only do the minimum and pick up the PUAs later?
So I'll give you guys some context. So Christian has been wanting to start a policy for a while. All of you guys probably have seen his name on this AMA every week. But it seems as though his cash flow has been a little inconsistent with his work, but he makes great money. So he's ready to start a policy and has been. We've applied twice, actually, and both times we had to expire the approval because he wasn't ready. We're coming up on that expiration date with One America, and he wants to fund it. Premium is set at $2,000 a month between base and PUAs. And he wants to fund, but it is not totally ready to do $2,000 a month yet, wants to give it a little bit longer. So the suggestion was, hey, let's just pay the base plus $10 of PUAs and do that for the next 3-4 months before you do $2,000 a month. And just pay the base and then do paid up additions and backfill the paid up additions when you're ready. So that's the scenario. We've been working on this for like a year. So Christian's pumped and super excited to do this, but it sounds like that explanation that I just gave didn't make a lot of sense. So then you guys can share a different explanation that would work.
Carson, it makes perfect sense. I got everything you're putting down. And Christian, come on, brother. We know you. We've had you at the finish line 3 times now. And you're on all of these things. You're a man of action. Listen to what Carson just said. Is it with One America?
Yep.
Take it down to the base. Add the $120 for the PUA for the year. And then when you start getting in the habit of putting the money into the base, you can go up to 3 times that and get your PUAs in to build that cash value. So at least you started, you crossed the finish line, you make the next step, because without the action, without testing, you're not going to accomplish the thing you're trying to accomplish, brother.
Yeah, Christian, like, let me come at this from a different angle. So cash flow is always a thing for me. You know, the way money comes in is the way that I save and the way that I do all my policies. And, you know, a lot of times, like, we're always doing the videos and we're always talking about, like, you know, doing everything annual. But listen, in your scenario, if your income is maybe not, you know, where you need it to be, but you still want to keep it at 2,000, maybe there's some inconsistencies. I love what Jason and Carson said. Take it to base. Okay. What is the base on that? Do you remember, Carson? Let's use actual numbers here.
500 a month, $2,000 a month.
500. So you got 500 a month, or so this is monthly. So do it for the 500 a month. Put an extra $10 in, so you're $510, and that's it. And you just funded it 510. Now each month that goes by, you know, if you have inconsistent income, when the income comes in, pay yourself first. And you got to build this habit, man. This is key, because you can't let this thing expire again. I'm going to hunt you down if you do, because you're literally hurting your future, your kids' futures. If you got any, even if you don't, the kids that someday will be, you're hurting their futures not doing this, because you're pausing, just getting it in your head. So $510 a month, you do that. Every month when your income comes in, pay yourself first. So take the difference, that $1,500, so to say, go and create that segregated bank account. Go whatever bank is in your town, whatever credit union is in your town, open a bank account. And what I want you to do is every month when your income comes in, before you pay your bills, take the $1,500, put it into that bank account. You're only funding your policy at 510, okay? Because this is a new thing. So 510's going in there. You're not going to miss that. If you committed to 2,000, you're doing 510. But the 1,500 is going over here into this other bank account. If things get rough, bills get out of control, 1 month is low, you just go into that bank account and you pay your bills with it. But you build that habit of the combined amount being 2,000. And eventually, once you do this, you're not going to ever miss the 2,000, because it's built in. I did a whole thing on this. Earl Nightingale talks about it a lot. I talk about it in the Laws of Wealth. Pay yourself first, man. The reason you're not moving ahead is because you're not doing that. You're paying everybody else first, and you're saving the leftovers. You ever go to a dinner, and maybe you heard this on the last one, but if you ever gone to a dinner and then you get to sit off in the side in the dunce corner and wait and watch everybody eat, but then when everybody's done eating, all their scraps are scraped onto a plate and then they serve that to you. Is that what you want, man? That's that's the life you're living. You're paying everybody else first and you're taking the leftovers. That's how you're saving. Backwards, dude. Change it. 510 into the policy, 1,500 into the segregated account. Now you got the safety and security because now you got all the money in case something bad happens, but you're building the habit and you're paying yourself first, which is the way it should have been from the beginning.
And Chris, I just want to add to that. I really like that approach because it gives them that safety net of that 1,500 every month. However, when you finally take that plunge and you start putting the full 2,000 in, think of it this way: you only really need to leave 300 in. If you needed it, you can get about 12, maybe 1,100 to 1,200 out. So even when you jump off the diving board, if we want to call it that, and you start putting in the full 2,000, you can still pull out 1,100 to 1,200 of that. So you're really leaving in 300. And it sounds like you're comfortable with that with the 500 anyway.
Absolutely. Well said. And he's got the spreadsheet to prove it, man.
I've got a spreadsheet to prove it.
He is good.
And soon those spreadsheets are going to be hanging on the wall because we don't need them anymore.
Nope. Yep. We're going to toss them right in the garbage can. We have a big bonfire with all these stupid spreadsheets.
There's a lot of flexibility. I mean, there's nothing, just to add, like if you're doing 500, that's 6,000 a year. You can put up to an extra $18,000 of PUA, and you're going to have access to 90% of it. So if you do what Chris just instructed, not only do you have the cushion, the control, the money there if something gets tight and the 510 feels like a lot, but once you prove to yourself you can do it, Christian, you can take all that, ask the question, and when it's available to put all that in there, you're going to have the cash value that you're looking for to be able to borrow, to make the things that we've all talked to you about. So you're there, brother.
He said he's there, man. He's already commented.
Friday, so
he's there, man. Friday's the day, and he said no leftovers for him. Way to go, man. I'm gonna look at all the reports, Christian. I'm just gonna let you know this. I'm gonna hold you accountable. I'm gonna look at all the reports on Monday. If you're not on that report as being in force, you're getting a call from me, and you're not gonna want that. Because all we're gonna talk about is how I'm gonna send you my leftovers every single day in the mail, and you're not gonna like that because my daughter always has nasty leftovers, and I'm gonna let them get nice and ripe out in the heat, and then I'm gonna mail them to you.
I like this format of the show. Let's bring more people on like Christian that are ready. Let's go. Hey, Christian, thank you for being brave and coming on here and letting us pour into you. But this is the community I want, is the people that are going to hold each other accountable for what we say we want to do.
And Christian, I'm just going to warn you, you don't want Chris's leftovers because it's going to be lettuce, beans, rice, and cucumbers. That's it.
Yeah, dude, with Italian dressing. We've been moving more to oil and vinegar now.
Oh my gosh, you guys are funny. All right.
Well, I got something, Stephen. We did this on Wealth Webinar, and I know some of you folks on here. We got 55 eyeballs aren't on here, so I want to just take just a moment and talk about something I'm super excited and passionate about, and it's not the software that Craig and I are working on. This is a personal passion project. When I wrote the book with Hannah, The Companion, which is our first children's book, the goal was to teach children, about problem solving, about doing what's right, about not stealing from their bank. The companion book is all about IBC, but you just don't know it because it's told in context of a little child and this little critter called the companion, which is technically the policy, and this magic kingdom that they go out into and explore, which is life. But the children's book is just one of many. So back a long time ago, you may or may not have remembered, I spent like a bunch of time with my team creating a TEDx talk, which is literally a letter I wrote to my daughter. My daughter was 2 years old, and that's what it's called. It's called Rethink Money, and it was the 6 Laws of Wealth. So I've developed this passion now that I've got a child. Carson, you'll see what this is all about when you have yours. Nothing like in your life will matter. It will all be about how do you benefit the child? How do you set them up? And in financial education is something I've been wildly passionate about because it doesn't exist. And it's funny, my daughter goes to a private school, but it's not one of those bougie private schools where only rich kids go. It's a private school that has a whole mix of people. They have all sorts of scholarships where just average folks can come in. And yes, There are some wealthy families that put their kids there, but it's a very old school. It's beautiful. It's small. And I went to the owner, not the owner, sorry, the person who runs it. His name is Keith. And, we started talking about our private foundation, which our private foundation is mine and Larissa's foundation. And we take our own funds. No one else contributes to it as of yet. We put our own funds in this foundation. And one of the big undertakings we had is going to Keith saying, hey, listen, we want to bring financial education to Park School. How do we do that? Well, the problem was they didn't have a way to fully instill financial education in with their current methods, but they had this goal, Stephen, do you want to pull that up, of creating this theater, okay? And arts, performing arts theater. And I said to him, okay, this is perfect. If we did this performing arts theater, that's really small, so I'll just read it. Like, could we use that to launch financial education for the kids, the parents, and the teachers? And he did some research. This is interesting. He did some research on this, and he found a couple studies, and these are in this thing. We'll put this in the chat. And there was several studies that were done showing that when a survey was done nationwide about parents wanting their kids to get financial education. It was like 88% of the Americans wanted this. And all these studies showed that there's a massive lack of financial education. So I said to him, if we donate a large amount to build this facility, I need it in writing that we are going to be able to launch financial education. I also need it in writing that you, as the head of this school, will take what we're creating with financial education and this arts and crafts theater. I keep saying arts and crafts. I know that's not what it's called, but in this building, okay? And I want to take this to every private school because Park School is very old and very well known. So if it works there, it will go to other private schools in the area and then eventually span out. So we pledged $1 million of our money from the foundation to this project, which gets us the buy-in. And I hate to say this in life, sometimes you just got to buy your way in, to buy in and to do this. And there's a whole article in here about how they're allowing me to create private financial education events in Noggle Hall, because that's the name of it, Noggle Hall and Performing Arts and Visual Arts Building. And it's going to basically then spin off into each classroom. So what we do in this new building is then going to create the curriculum that's going to be used throughout all Park School and every grade, including creating budget type modeling in the Montessori program, which is little kids. My ask is, we did this last time and it was great. We just raised almost $2,600 on Wealth Webinar. I'm asking all of you to donate to this cause. I know it's not in your backyard, but you know what? Someday this could be the domino that went down that allowed financial education to expand into other areas. It's not a quick fix, but it's a long-term fix, and this is how we're doing it. So any of you that donate, here's my give. If you donate anything you want or any dollar amount, okay, you're going to get a book. Okay, the companion, I will mail it to you. Doesn't matter the amount, just donate. If you donate $250 to $500, I will give you the companion book. I will personally mail it to you. If you donate $500 or more, I will not only sign it, but Vivi, my daughter, she'll also sign the book, but draw you a picture. She's very much into drawing pictures. So every donation gets a book. 250 gets a signed book. 500 or more gets a signed book by me and my daughter, Vivi. So that's my give. That's my ask. Thank you so very much. We'll put the link down here in the chat. It's a GoFundMe, and it does not go to my foundation. It goes direct to Park Schools Foundation. You'll be able to, and I got the buy-in from Keith. Everybody that donates, what we're going to do is create a list, and we're going to start sending all the updates of like the developments of this. So thank you, everybody. What else we got, Sean? Any other questions coming in?
One more, I think. Good, two. Wait a second. Okay. So Chosen 1970 said to Chris, I know that you have about 20 different businesses you operate. I'm wanting something, if possible, that I can set it and almost forget it outside of PMC.
So I don't know how many companies I have now. Shauna would probably know more than me. Not 20 yet. I don't want 20. Probably close. Wanting something that you can set up and almost forget outside of PMC. So outside of doing private lending. All right. So let me talk to you about something else I do. something you could do through, one of our companies called PMC Wealth, who Brandon Beckinghausen is the advisor and runs. It's treasury bonds. They're boring, man. I'm going to be honest with you. They're boring, but the upside right now is significant. And there is just no way it's not going to play right into, your hand. I can't give it. This isn't investment advice. I'm not giving you recommendations or anything. This is just what I'm doing because I understand this. Treasury bonds are IOUs from the U.S. government. So you basically lend the U.S. government money for a period of time, and that's called duration. And as you lend them money, they pay you interest on that money. So if you go long, which means go out like 10-year treasuries or 30-year treasuries, you do not need to hold them that long. There's no way in hell I'm owning these 30-year treasury bonds for 30 years. It ain't going to happen. But here's how it works. The longer the duration you go, the more price fluctuation you get based on interest rates. So right now, interest rates have been held high by Jerome. Trump wants them to come down, and eventually with the Fed is going to hit their target or get there where they're going to have to drop rates. When the rates come down, the price of the bonds, not the interest rate you're paid, but the price will go up. So this provides you a really amazing opportunity to buy what would be considered a risk-free or a low risk investment, because you're basically buying you're loaning money to the government. You're buying a bond from the U.S. government. They're not going to default because they print the money that the bond is issued in. They can't default. They can't go bankrupt. So that's what I'm doing. I'm not doing it because the bonds are paying me 3 to 4, maybe 4.5%. I'm doing it because I know I'm buying them at rock bottom price because the Fed jacked rates up, bringing the price of the bonds down. And then good old Moody's downgraded the United States of America, which dropped the bond prices even more. It's just like, it's like rollback times 10 at Walmart. The prices just got slashed and then slashed again and then slashed again. And shit, I'm buying, man. So if you don't want PMC, maybe you don't want the risk, you don't understand it. There's very little you need to understand about treasuries, except for they're guaranteed by the full faith and credit of the United States of America. And if you believe that holds water, giddy up and go. If you want some help, I could connect you with Brandon over at PMC Wealth and get you connected for that. But they're very easy, very predictable, and you can do your own research on them. So that's an option.
Sweet. Are you saying that if Brandon over at PMC Wealth can help people actually do that too? Like, is that part of the stuff that the offerings that he does?
Yeah. So in all the offerings, there's what's called cash management, and in the two, not the lowest offering, okay, but in the two higher offerings, that is the treasury, what we would call treasury structure or treasury strategies. That would all be part of that. So if you're interested, we could set you up with a call with Brandon, and you could discuss that.
Sweet. Okay. Rose is saying, don't know if I'll pass the medical exam. I have $85,000 in a 401k. Can I open an account under grandkids' name and use it as if it's mine? P.S. I haven't done taxes in years due to illness. I'm much better now.
Have you even had lunch?
We have a lot of clients that have, policies they're doing with grandkids. You're not really opening up under your grandkids' name per se. It's the policy is on the grandkids, and then you can be the owner of it. Now, as far as the taxes, I'm not sure how that would affect the underwriting, though. Anybody have any experience with that one? If the owner of the policy has not done taxes in years, would that affect the underwriting of the policy if they're the owner but not the insured?
Yeah, does that matter on their income, basically? Like,
I think so. No, it's really just stated income unless they ask you to provide proof. I can't imagine that. I mean, if they were back in taxes and they owed the government money, that would come up in a search. But if they just haven't done taxes, I don't think that's going to have any bearing on anything.
Yeah, I mean, it all depends on the age of the grandkids too. That's a big factor right there, is the age of the grandkids and how you can fund the policy, because under 18 versus over 17 dictates how you can structure the policies. So keep that in mind. But that'd be a phone call for sure.
And it almost sounds like, Rose, that you are framing the question as if you think you are uninsurable, which is why you want to try and insure your grandkids, yet use it yourself. So if that's the scenario, then we can work on it. But don't talk yourself out. We would want you to be covered as well. especially if you have cash, you have income, you have bills, you have things you need money to be used for, you could be your own bank. So I would definitely try and cover yourself before anybody else. But if you are uninsurable, then great. Yeah, we can look at insuring other family members. And if you're looking to insure your grandkids, I will tell you that policies for minors tend to not be very big. You probably can't put in 85 grand from a 401k into a policy on a 10-year-old or however old they are. So I would also keep that in mind. If you're setting up a policy on your grandkids, it's going to be pretty limited, and it's really probably going to end up being for them, not you. But we can definitely find a way to insure somebody for you to become your own bank. So definitely set up time to meet with us. I'm pretty sure we'll put our link in here for you to spend time and book with us to figure out your situation more.
Another thought, and thanks both of you. Another thought would be, I've had this before where someone's not insurable and they have the means, but maybe your kids, depending on what their scenario looks like, if you're trying to do bigger policies like Carson mentioned and Brian mentioned, kind of the limitation with a kid's policy would be finding your kid that's open to learning this, open to letting you use their body as an insurable interest, and then you can do it that way as well. Because I've had a couple people have success with that. So
it looks like she may have equity to tap into as well, potentially. She says that she owns 2 houses. The first one is paid off. Her daughter's 34, and then she owes 88 on the second house. So definitely have some things to work with there. And I put the link in the chat. You can go to mentors.beyourownbanker.com to book a call with our team. And then Shane is asking, what examples would you use for a declaration of a family trust that would incorporate IBC, education, and whole life? Is there a way you've written in for books they need to read for understanding?
I didn't in mine, but that's a good idea. You can do anything. I mean, it's your word, it's your language, it's your rules, because it's your trust. So you can word in all of that. I mean, mine specifically calls out, the private banking system in the whole life policies and infinite banking and being an honest banker. But I probably should have put that in there. I can always go in and modify my trust and add books to read, but I like that idea.
There's a Netflix movie. It's kind of like a chick flick, but it's like this mom passes away and she makes like all these things for her daughter to have to do in order to get what she is supposed to get, like sing karaoke and do all this other crap. So you could do something like that too. Tell them to read a book for sure.
There's an amazing book. Hold on. Now that we're on the book thing, like I'm writing a brand new book. Actually, it's pretty much done, but I'm not going to release it for a little while. But it was all based on a book that I read that just was so phenomenal. Let me try to find the name of the book. It was a while ago that I finished it. I've read it twice now because it was just so captivating. But Shane, I think that was from you.
You would watch it.
Yeah, of course. Oh, here we go. Shane, you probably heard about it. It's called The Ultimate Gift. I think there was actually a movie made on it. Jim Stovall is the author, and the book is called The Ultimate Gift. I think you'd love it because in there it's about a super wealthy billionaire who dies, leaves a VHS of like his wishes and like the things. Most of the family gets like all their hand downs and what they wanted, and they just leave. That's all they showed up to the funeral for, and the attorney's offices get it. And then the one kid, I can't remember what his relation was. He had to watch this video, and basically what this whole thing was, he sent this kid out to do all the things he didn't want to do because he was just a spoiled brat because he grew up in his family's money. But he sent him out to do all these things, and they were all things that this guy, the billionaire, did during his life that were hard work to become a billionaire, like digging fence holes. And he sends him out to his friend to dig fence holes, and he puts him on all these journeys to do these really hard things, these things of giving and having to sacrifice and having to do hard work. And the kid reluctantly gets through it all, but gets the lesson in each one of them and then starts to like the hard work in these lessons. And at the end, nonetheless, I shouldn't give the whole book away, but obviously the billionaire leaves.
Lee was hanging right there.
Yeah.
Well, there is a movie, and it's actually one of my favorite movies as well, but there's a bunch of little spin-offs of it after the main the main thing happens, then it goes into the next phase. But it's kind of cool because, like you say, Chris, they have the ultimate gift is really what the show's about. But he learns the gift of work. He learns the gift of charity. He learns the gift of
same thing.
All these different things. But
that must be all based on that book, because that's exactly what it is. And it's a miraculous ending, really cool. But it just makes you want to set your stuff up exactly like that.
Yeah.
Now my mind wants to know if Shauna's chick flick was actually based on this or the other way around.
It might be. So a lot of other people in the chat have actually watched it. So it's called The Life List. And it was like she had 12 months to do all these 12 things, like heal a relationship with her father, become a teacher again because she had given up teaching for some reason. So all these things. So it's on Netflix. And I feel like it probably was based off that book.
I'm sure there's tons of spinoffs.
All right. Chosen 1970 is saying, and this is in regards to those bonds, is if Armageddon comes before my bond matures, is there a refund?
First and foremost, I would never plan as a refund. I would never hold the bonds to maturity ever. I'm playing the short-term game, which is just the interest rate movement. So when the Fed drops interest rates, the price of the bonds skyrockets. So you all know Warren Buffett said, buy low, hence the low price now, and sell high. So high is when the Fed drops interest rates, which is probably within the next year, maybe. I can't predict that. And then don't lose money. So there's no way in hell, like I thought I said it there, but I'll say it again, that I'm holding these things to maturity. It's just not going to happen. I'm buying them low, getting paid interest while I hold them, and then selling them high and not losing money.
Well, and if Armageddon comes, you need to be invested in something else other than.
And if Armageddon comes, it's not going to matter what you're invested in. You're not going to give a shit because you're going to be dead.
Just drive towards Fouts. Go where Fouts is. There's grenades. There's bunkers. You got everything up there. You got bears to hide behind. Whatever you need.
Yep, there you go.
And just so you all know, super exciting. I'll let a little cat out of the bag. So as you all know, Bigfoot's been really making a comeback on social media. Like he's right now the #1 influencer on social media. So in my ultimate wisdom, I decided I would just go out and hey, let's see if we can get Bigfoot on my podcast. So Bigfoot, we did an interview with him, and he watched some of my stuff, and he had something he wanted from me. So because he knows we're in the money space, and he's got this huge ask, so he agreed. Bigfoot agreed to come on Money School Podcast. So in a couple short weeks here, I will be interviewing Bigfoot, and I will be solving a big problem for Bigfoot. And don't tell Bigfoot this, kind of a secret, but Yeti, he hasn't signed on to come on the podcast, but I'm pretty sure Yeti's going to come on because he's kind of following Bigfoot's footsteps. He's trying to get the limelight. So I'll probably have Bigfoot on and then Yeti right after that. It'll be an epic interview.
Okay,
I wonder if they get along.
That kind of rolls into this question. Then Kathleen saying, what are all your thoughts on AI and how will it affect traditional banking and any issues with IBC? What do you see or feel coming in the future besides an interview with Yeti?
So this Pepe Le Pew project that Craig and I are on is wholeheartedly based in AI. And the more I've learned about AI, the more I'm kind of understanding how to properly use it, how to properly structure, AI bots and things. Like it's fantastic. The problem with AI is there's just some loose cannons, and AI only learns what you feed it. So it's kind of like, if you have a kid and you feed it junk food every day, well, your kid's probably going to be obese. So you gotta feed AI the proper info if you want the proper output. So what is AI going to have for the future of IBC? Well, you'll just have to wait and see, because we're paving the road for you.
But even from the carrier's perspective, though, Chris, it's going to make underwriting faster. It's going to make the policy information more accessible. It is going to keep improving our lives. And it just as long as, like Chris said, you're putting the right inputs in, you built it to do the right tasks. I saw something the other day where there's different GPTs or different AIs for different kind of thought processes. Like, are you looking to create something? Are you running spreadsheets? Are you doing this? So it's going to get more and more specific the more that we train it properly to work for us. So it's going to be exciting.
I was just thinking about this the other day. If all this AI and the ability to create all these graphics, if people are going to start to lose the ability to do, like artists, are they going to lose the ability to actually hand draw something? Are people going to lose the ability to start thinking as critically as they need to be because you can just go ask AI? So I don't know. I think like every technology, there's good and good and bad about it, but I think there's some considerable things about AI that could be a downgrade of our society, just like social media was, even though we use social media for good things and bad things.
And this is just because Craig is worried that as a robot, he is, going to be unplugged and no longer as, just kidding, Craig. So
I'm not quite sure what you're planning, but I didn't understand. So.
Oh my goodness.
Okay.
All right. SB is saying, hello again, just got on, but I have a question about PMC regarding setting up for my LLC for complete anonymity. Is that something your group teaches or will actually do for me?
I mean, you'd have to have someone who's licensed in that field to really give you that advice. So that would be either an attorney or an LLC specialist, whom we have those contacts for. But I mean, you can have an LLC for anonymity, yes. I don't know if Stephen or Chris, you guys know, do they talk about that inside PMC? Using LLCs for anonymity? I mean,
yeah. I know, I can't. You can say that word. I love it. Thanks, Brian.
Well, there's someone we can refer you to. That's the gist of it.
That's exactly.
It's part of the blueprint call, correct, Stephen? You have the link or something for it to help that out? I don't think we don't teach it, but necessarily it's part of it.
Yeah, I would just say just send me an email and I'll connect you with the right person to help with that if you're looking to be anonymous.
Well, thank you. Okay, J10 is saying recently saw the non-direct versus direct recognition video. Oops.
Oh, sorry.
That's okay. Live in New York, the Guardian live in New York. So Guardian seems to be the company to go with. Isn't the loan interest lower since it's direct recognition?
Well, there's technically 3 companies in New York you could use. I mean, you could use Mass Mutual, but they're going to tell you can't take loans in the first year, but they're a good company. I mean, I have several policies with them. Guardian's a good company. I have one policy with Guardian, but they are direct recognition, which is why I use a CV line of credit. Because they're direct recognition does not mean their loan interest rate is lower. I think they have like 2 options for loan interest rates in Guardian. One might be lower, and then one's a little bit higher, and it just depends on which option you take. And then Security Mutual is another great carrier in New York. Probably I have a policy with them. It was actually my first IBC policy with Security Mutual, and I will tell you they're the best customer service in the industry. That policies perform very well, and their loan interest rate is very low, and their direct recognition. So if you're kind of looking for low interest rate, good company for IBC, in non-direct recognition, then go with Security Mutual.
Yeah,
and you can build their policies really, really aggressively.
Yeah, and I'll just add in that video, Chris, when we did that, we actually used Guardian software to project out the cash value. So what you're seeing in that video is the reality of their loan interest. So it's not something that we made up. It's just something that the Guardian software shows. But it can, I mean, not to say Guardian can't be a good solution. It just really depends on what you're doing. And as we talked about in that video, if you're taking shorter term loans, there's less impact to those dividends. But if you're taking a loan and not paying it back for a while, that's where you're going to see some of the bigger impacts.
Robert When will this be available for replay? This actual video, you can probably share it now or as soon as we end it. I think it's available for replay. And then the Wealth Wednesday webinar will be like from today is live on the YouTube channel on Saturday. Okay, then in addition to that LLC question, if I have properties, can you help me with a land trust and tie it to the LLC for anonymity and financial protection? I'm learning so much new things about myself today.
Corporate capital certainly can do that. There are some advantages to the land trust. It's really more portability is, I think, the word I would use for land trust. Like we used to use land trust when we were doing a rental or a flip. We would buy the property in a land trust. And that way, when we sold the property or the rental, we literally just sold the whole land trust. So you just sold the whole thing, not disrupting the LLC. If you buy a property in an LLC and you sell it, there's just more bookkeeping. So it just made it more portable. I don't know as if a land trust is really going to give you any more financial protection. The LLC certainly will, like a Delaware, Wyoming, or Nevada LLC will give you the anonymity and financial protection you're looking for. So you may not need the land trust unless you want that portability. But yes, corporate capital can give you all that advice and give you the legal behind what you're trying to accomplish. I'm just speaking from experience.
Marketing. Hi, just logged on. I watched a video where Chris talked about the whole life premium required for 10 years only. Is this the norm?
That's a good one. Who wants to take that one?
Not the norm, but it's one of the ways we can use 10-pay policies. Typically, we let, since we understand the power of really what happens with these specially designed whole life policies, we want to be able to keep paying into these policies for as many years as we can typically. But depending on your situation, we've got different options we can look at to use based on what's going to meet your needs.
And what you might be referring to is that we show a lot of the policies where the premiums drop down at year 11, where we're dropping the paid up additions off because the policy has become extremely efficient, meaning in year 11, because you've been funding it for 10 years, you put in $1, but you get $3 back out in growth at year 11. So we like to show that efficiency, and that's how we do it. But oftentimes it's optional for you to drop the premiums down at year 11. You don't have to. So if you want to keep funding the paid up additions, which is the cash value portion of the premiums, by all means, keep funding it beyond year 10. We just show the option of it dropping down so you can see how efficient it's become. But we can walk you through those numbers on a one-on-one call, of course.
Well said.
Here's just on that land trust, Brandon sent me something, and it's kind of what I said, but he said, Chris, a land trust won't protect you like an LLC, which I mentioned. It's usually used to prevent a due on sale clause when moving a property to an LLC, or when doing what you said, you can sell it with the trust. So I was mostly right, but he just wanted to correct me. That's our compliance officer.
I've never heard of a due on sale called.
Yep, and we're not the ones doing land trust or anything like that.
No, we don't do that. Again, that was just
no financial advice here. No financial advice here.
What do you say about AI in the financial advisor position? I think if financial advisors don't really quickly adapt to using AI in the proper ways, they will become extinct. And I am doing my part to try to help them become extinct, or at least the traditional ways of financial advisors work. I'm just kidding, but I'm definitely trying to change that industry and create a major disruption in it because it's broken.
Okay, and then Timothy Lee is saying, upon paying my loan back, is there some hidden growth to cash value other than the straight dollar for dollar cash value increases based on premium payment amount?
You're going to have the growth, right? That's uninterrupted and compounding the cash value you have in there. And as you're paying it back, like Craig can show with the math and all the stuff being built, you're going to reduce the simple interest going back. So you're going to make more money that way, but there's not additional hidden growth necessarily. You're just
But
going to
there
be.
is. And that's what we've recently found. Like, it's a very interesting thing, and I didn't want to get into this, but like the software, the thing that me and Craig are going to be, showing everybody sooner than later. There was something that came out of this, and I would say Craig knew this, but we'd never really talked about it. But just put it this way, Timothy, if you borrowed money from your policy at 5%, and let's just say you paid yourself back 5%, right? You would think there's nothing more. Like the insurance company's charging 5%, you're repaying it at 5%. Okay, so let's just say you did that. Normally, that'd be a 0% gain. Like you'd make nothing, but that isn't the case. You actually would. And I'm not even talking about the uninterrupted compounding interest. That, forget about that for right now. Like that's there, yes, but I'm just talking dollar for dollar. Took a 5% loan, repaid it at 5%. The way the interest is calculated on the loans with the insurance companies and the way you pay them once a year. But if you're repaying the policy back monthly at 5%, which is the way we teach, you're actually knocking the loan down. So since the insurance company only charges you interest one time a year, because you're knocking it down, dollar interest rate for interest rate, dollar for dollar, apple for apple, you're getting ahead and you're noticing an arbitrage. I've never taught this before. I've never talked about this before because I didn't even think that could exist. But there is an arbitrage in there. So I know that's not what you're saying, but that is hidden growth. It is hidden growth, not growth in the cash value, just hidden growth in mathematics that nobody's talking about because nobody's just run the math. But now we are, and we're like, holy crap, this just keeps getting better. So that is the hidden value you're going to get. But it sounds to me like in your question, I think you really need to go back and either read Nelson's book or watch the 90-minute video because it's the process that's going to make you the money. Okay, so it's the process you need to stay focused on. And here it's to me just sounding like you're trying to find a way to say that this doesn't make sense. I don't want to pay interest on my own money. You're not. And that's where the mathematics comes in, and you have to understand the process of what you're doing. What you are, for people that think, oh, I'm not going to borrow my own money. Good. Keep doing what you're doing. Keep paying the banks all your money, and you're gonna wish you would change things because nothing's going to change in your life because you were too stupid or just, what is that word what's the word when somebody doesn't want to learn something new? Ignorant is one word. There's lots of words for that, but too ignorant to want to learn something new that could drastically change your financial future.
Stubborn.
Well, and kind of what's funny to that whole conversation is, you talked about a 5% loan from the insurance company and a 5% loan repayment. We can show you that even paying at a smaller level back, even though the insurance company is 5%, you might be paying 4.5%, and you're still making money. So anyway, it's all going to be revealed, and you can play with the numbers to your heart's content.
Would you like to know how? Just put 25 cents in the little slot below, and we'll tell you. All right. Well, with that being said, we are at time, and we don't have a little slot for 25 cents. So with that being said, all you got to do is just go in there and donate to that whole project for financial education and get yourself a copy of the companion. And if any of you are big ballers putting in 500 or more, Vivi will have a blast drawing on your book, and you will love it. You'll be one of a kind. So with that being said, thanks everybody. And thank all of you money mentors for joining us for this Ask Me Anything happy hour. Hopefully it was serving everyone well, and hopefully you got what you wanted from it. Until the next time, which is tomorrow, we will see you soon.